So imagine Jeff Bezos takes like his billions of dollars in physical cash, right? And he locks himself inside some secret doomsday bunker.
Okay.
If he eventually emerges as, the last person on Earth, all of those stacks of paper are instantly, utterly worthless.
Oh, completely.
Or picture him taking those $100 bills to an isolated tribe that uses, rare shells as currency. They'd look at him like he's out of his mind. The paper has absolutely no inherent value to them whatsoever.
It really doesn't. And it's a great thought experiment because it strips away this huge illusion that we interact with every single day.
Right.
We treat money like it's a fundamental force of nature, like gravity. But at its core, money is really just a social construct.
Yeah.
It relies entirely on our collective ongoing agreement that it actually holds value.
And understanding how that agreement is currently being manipulated is the entire mission of today's deep dive. We are looking at the insights from Rob Dix's really fascinating book, The Price of Money.
It's such an eye-opener.
It really is, because usually when we try to get our financial house in order, we focus on the micro level, right? We agonize over finding a savings account with a tiny fraction of a % higher yield.
Right, or we clip coupons to save $20 on groceries.
Exactly. But trying to optimize your personal finances without understanding the broader macroeconomic forces at play is essentially it's like doing beautiful interior design work on a house you've built on the edge of a cliff.
That is a perfect way to put it. The foundation is precarious. I mean, if you don't understand the mechanics of the ground beneath you, the color of your curtains won't matter at all when the cliff gives way.
Yeah, exactly.
The rules of the financial game have changed drastically over the last few decades, and those systems are intentionally opaque.
Right. So if you've ever looked at your paycheck and felt like it just doesn't go as far as it used to, you are not imagining things. To decode those hidden mechanics, we have to start at the absolute foundation. What actually is money, structurally speaking?
Well, to qualify as money, a thing needs to successfully perform 3 distinct jobs.
Okay, what's job 1?
Job 1 is, it has to be a medium of exchange. It's the thing we all agreed to accept as payment just to avoid the total nightmare of a barter system.
Right, because bartering relies on that double coincidence of wants.
Exactly. You can only get a haircut if your barber happens to want, like the carrots you grew in your garden. Money solves that friction.
Which is why nobody buys a laptop with a truckload of root vegetable.
Thank goodness. So medium of exchange is job 1. Job 2 is acting as a unit of account.
Like a measuring stick.
Right, a universal measuring stick. Yeah. It allows us to compare the value of an hour of labor, a commercial airliner, and a cup of coffee using one common numerical language.
Makes sense.
And then there's the third job. And this is the one where our modern system goes completely off the rails.
Okay.
It has to act as a store of value, meaning you need to be able to hold on to money today and trust that it'll retain its purchasing power when you need to spend it 5, 10, or 50 years from now.
And since practically anything can be money, as long as we agree on it, shells, glass beads, giant stones, human societies spent thousands of years experimenting with this.
They did.
But they almost universally converged on gold.
Yeah, they converged on gold because it naturally ticks all the necessary boxes for those 3 jobs. Mm-hmm. I mean, it's fungible, meaning any pure ounce of gold is chemically identical to any other ounce.
Right.
It's incredibly durable. You could drop it in the ocean for a century and it won't rust. Right. It's divisible, portable, easily recognizable. But the most important feature by far is its scarcity.
Because scarcity forces trust. I mean, I'm only willing to trade 40 hours of my hard work for money if I know the person paying me also had to expend significant effort to get that money.
Exactly.
And money literally grew on trees. I'd feel cheated getting paid in leaves because anyone could just rake them up.
Yeah.
Gold requires immense physical effort to extract from the earth.
And we see that exact same principle of scarcity playing out today in the digital realm with Bitcoin. Yeah, it functions quite similarly to gold because it's limited by mathematics to a strict maximum of 21 million coins. Mm-hmm. It enforces absolute scarcity, which is the bedrock of a reliable store of value.
So if strict scarcity is what makes gold the ultimate, naturally perfect form of money because of that strict scarcity, why did human societies ever abandon it for pieces of paper?
Well, the answer to why we abandoned gold is exactly why the money in our pockets today is spectacularly failing at that third job.
Being a reliable store of value.
Exactly. It doesn't store value at all anymore. We tend to think of $1 or £1 as a static measuring stick. $1 is $1, right?
Right.
But the historical data totally dismantles that illusion. Let's look at the British pound during the era of the gold standard.
Okay.
If someone in 1837 put 100 pounds in a vault, and they took it out right before World War I in 1914, it would buy the exact same amount of goods.
Wow, that's nearly 80 years of perfect price stability.
Perfect stability. But if they left that exact same 100 pounds in the vault until 2022, it would only buy 87 pence worth of goods today.
Wait, 87 pence out of 100 pounds?
Yeah. It lost over 99% of its buying power. And it's not just ancient history. You know, a $100 bill lost in a coat pocket in the year 2000 has already lost over 40% of its purchasing power today.
That is wild.
We just don't riot in the streets about it because the loss happens gradually, day by day.
The housing and food data from the source material really drives this home, I think. We all talk about how housing prices have skyrocketed over the last 50 years.
Oh, constantly.
And we price those houses in dollars or pounds and think they've gained massive value. But if you price those exact same houses in ounces of gold, they cost practically the same today as they did in 1970.
Which is mind-bending. The house didn't magically become vastly more valuable. It's the same bricks and mortar. The currency we use to measure its value just became exponentially weaker.
Right. It takes more units of weaker money to buy the same hard asset.
Exactly. And the same logic applies to food. When priced in gold, food costs have actually plummeted since the 1960s.
Really?
Yeah. I mean, human innovation, better tractors, optimized supply chains, they made food production massively cheaper.
But we don't feel that benefit at the grocery checkout.
No, because our currency is losing value faster than the food is getting cheaper. It completely reframes how we experience the economy.
It's like a child marking their height on a wall every year, right? They look at the numbers and think they're growing 10 inches a year, but really, they haven't grown an inch. The ruler they're using to measure themselves is just shrinking.
Oh, that is the perfect way to visualize it. The ruler is shrinking.
And if the ruler is constantly shrinking, someone has to be actively shaving off the edges. The invisible mechanism doing that is inflation.
Yes.
We hear that word constantly, usually as a complaint about gas prices or groceries, but the actual mechanical definition of inflation is crucial here. The source defines it as a persistent, substantial rise in the general level of prices related to an increase in the volume of money.
The volume of money is the trigger. If you have more money swishing around in an economy chasing the exact same amount of goods and services, basic supply and demand dictates that each individual unit of that money becomes worth less.
But the wild thing is that this isn't some tragic accident, right? Or a glitch in the system. Major governments and central banks explicitly target a 2% inflation rate.
They do?
They actively engineer the system so your money loses value every single year. Why would anyone intentionally do that?
There are three main macroeconomic reasons for it. First, central banks are just terrified of a deflationary spiral.
What does that mean?
Well, if money becomes more valuable over time, people expect things to be cheaper tomorrow, so they delay purchases.
Oh, so they just hoard their cash.
Right. And if everyone stops spending, corporate revenues drop, factories close, people lose their jobs, and the economy basically grinds to a catastrophic halt. To prevent that, they bake in a little bit of inflation to keep you spending.
Basically use it or lose it.
Exactly. Which leads to the second reason, forcing investment. If you know the cash sitting under your mattress is quietly rotting away, you're highly motivated to put it into the stock market, buy real estate, or start a business.
The government wants your capital out in the world, theoretically growing the broader economy rather than sitting idle.
But the third reason is the most powerful and, frankly, the most cynical. Inflation devalues debt.
Wait, let me make sure I'm getting this math right. If I owe $100,000 and inflation halves the purchasing power of $1 over a decade, I still owe the nominal $100,000.
Right.
But my wages have likely inflated too, so I'm paying back the bank using dollars that are functionally worth half as much as the ones I originally borrowed.
Yes.
It makes the debt twice as easy to clear.
You've got it. Now scale that up to the biggest debtor in the entire world.
But the government.
Exactly. When governments owe trillions of dollars, a steady rate of inflation quietly melts away the real burden of that national debt. They get to borrow massive amounts of purchasing power today and pay it back decades later with heavily diluted currency. It's essentially a stealth tax on anyone holding cash.
Wait, so my savings account slowly losing its buying power isn't a glitch in the system. It's a deliberate, engineered feature designed in part to help governments quietly pay off their own massive debts.
That's the reality of it.
That's incredible. To understand how governments gain this immense unilateral power to legally and quietly devalue our money, we have to trace how those in power slowly centralized control and changed the rules.
It's a centuries-long tug of war. Look at England. In the Middle Ages, local moneyers were tasked with stamping silver coins.
Okay.
But human nature being what it is, they started secretly melting down the coins, mixing cheap tin into the silver, and keeping the leftover silver for themselves to skim a profit.
Classic.
Right. King Henry I caught on to this debasement and famously had their right hands chopped off as punishment.
Wow. Brutal, but I guess effective quality control.
Very effective. But fast forward a few hundred years to King Henry VIII. He decided to centralize all coin minting in London under the direct control of the crown.
Okay. Consolidating power.
Right. And once he had an absolute monopoly, he realized he was short on funds. So what did he do? He legally debased the silver content himself, dropping it from over 90% pure silver to just 1/3.
He did the exact same thing the early moneyers lost their hands for.
He did. But because he was the king, it was officially enacted monetary policy.
A classic case of rules for V, but not for me.
Exactly. It highlights that whoever controls the mint controls the wealth. And that centralization took a massive leap forward in 1694.
Right, the creation of the Bank of England.
Yeah. England was fighting a brutal war against France, the navy needed rebuilding, but the crown had defaulted on so many previous loans that wealthy merchants just refused to lend the king another dime.
So to get around this, they created the Bank of England.
This was the birth of the national debt as we know it today. Instead of the monarch borrowing money personally, the state borrowed the money. They raised £1.2 million in 12 days.
That's a huge sum back then.
Massive. And crucially, the Bank of England started issuing paper banknotes to depositors as a convenient receipt for their physical gold. But pretty quickly, the bankers realized that people rarely came back to demand their heavy physical gold all at once. The paper was just easier to trade.
The ultimate temptation for any institution, if people are just trading the receipts, you can print far more receipts than you actually have gold in the vault.
And they did.
And whenever governments face a massive crisis, usually a war, the physical constraints on money are the very first casualty. We saw the gold standard totally abandoned during World War I because governments simply couldn't physically mine enough gold to fund the military-industrial complex.
They had to print what they needed. Which eventually leads us to probably the most important date in modern financial history. August 15th, 1971, the Nixon shock.
Let's contextualize this because it's the pivot point for the entire modern economy. After World War II, under an agreement called the Bretton Woods system, the US dollar became the global reserve currency.
Right.
The global economy was essentially pegged to the dollar, and the dollar was explicitly pegged to physical gold at $35 an ounce. Other countries could hand in their dollars to the US Treasury and demand physical gold in return.
But by the late 1960s, the U.S. was spending massively. They were funding sweeping social programs, fighting the Vietnam War, and racing to the moon.
That's a lot of bills to pay.
A lot. They were printing far more dollars than they had of physical gold to back up. Other nations, particularly France, did the math, got suspicious, and started aggressively converting their dollars back into gold.
So the U.S. was bleeding gold reserves at an unsustainable rate.
Yes.
So President Nixon went on national television and announced he was temporarily suspending the convertibility of the U.S. dollar into gold.
And here we are, over 50 years later, still in that temporary state.
Unbelievable.
That was the moment the world fully transitioned to fiat currency. The word fiat comes from Latin, meaning let it be done. It's money simply by government decree.
It has value solely because the government says it does.
And demands you pay your taxes in it. We are currently living through an unprecedented half-century global experiment where every major fiat currency is backed by absolutely nothing but trust.
Which brings up a really crucial logistical question. Since 1971, if there is absolutely no physical gold backing the money and no practical constraint on making more of it, how exactly does new money enter the economy? Do they just fire up massive printing presses in a basement somewhere?
You would think so, but the reality of our modern keystroke economy is far stranger. Let's look at a fascinating contrast from the source.
Okay.
In 2009, a group of forgers in Chiswick, London, illegally printed £5 million in fake paper notes. They were caught, prosecuted, and sent to prison for years.
As you'd expect.
Right. But just 8 months prior, The Bank of England legally created £200 billion completely out of thin air through a process called quantitative easing.
Wow.
And the central bank governor who oversaw that creation was knighted.
So the only difference between a felony and a knighthood is having a government charter.
Pretty much. Now, quantitative easing is a bit of technical jargon. Basically, instead of printing physical cash, the central bank types digital money into existence and uses it to buy financial assets, like government bonds, from large financial institutions. This floods those institutions with fresh cash.
But here's the biggest, best-kept secret of the entire financial system. The central bank doesn't actually create the vast majority of the money circulating in the economy.
No, they don't.
Commercial banks do, your local, everyday, high street banks.
Yes. And I want to walk through this slowly because it completely shatters how we're taught banking works.
Okay, let's do it.
If I go to my local bank to get a mortgage, or say a baker gets a $100,000 loan to open a new shop, the bank isn't going to a vault and handing out the deposits that other customers have diligently saved up.
Wait, really? They aren't acting as middlemen, quietly sliding existing money from a saver's account over to a borrower.
Not at all. When that baker signs the paperwork for a $100,000 loan, a bank employee literally sits at a computer, opens the new account, and types a 1 followed by 5 zeros.
They just type it.
They literally type it into existence through double-entry bookkeeping. They create an asset, your loan, and a liability, the money in your account, simultaneously.
So the money is created out of absolute nothingness in that exact moment.
Yes. And on the flip side, when that baker pays back a portion of the loan every month, the money is destroyed.
It ceases to exist.
It ceases to exist in the money supply. Taking out a loan creates new money, and repaying a loan destroys it.
So commercial high street banks aren't matchmakers pairing up savers with borrowers. They are actual money factories, and the central bank just controls the speed of their assembly line by adjusting the base rate.
Exactly. The central bank doesn't want commercial banks going rogue and creating too much money too fast, because that triggers hyperinflation. So they control the assembly line speed using the base rate, the baseline interest rate they charge commercial banks.
Got it.
If the central bank lowers the base rate, commercial banks can offer much cheaper interest rates to consumers for mortgages and business loans. Cheaper loans mean more people want to borrow.
And more borrowing equals a massive surge of new money being created and pumped into the economy.
Right. And conversely, if the central bank raises the base rate, mortgages and credit become painfully expensive. People stop taking out loans. And as old loans are slowly paid off and destroyed, the overall money supply actually shrinks.
So the central bank is managing the entire global economy simply by manipulating the price of debt.
Yes. Which brings us to the inevitable structural consequence of a system designed this way. Because new money is only born when a new loan is taken out, our entire modern economy relies on an endless, ever-growing stream of willing borrowers.
If people stop taking on debt, the money supply shrinks, businesses fail, and the economy collapses.
Precisely.
So who is taking on all this debt? If the system relies on cheap borrowing, and individuals, companies, and governments have spent 40 years borrowing to exist, who's holding the bag?
Since the 1980s, the answer is absolutely everyone. There has been an unprecedented explosion in private debt. The catalyst was the cost of borrowing plummeting over a 40-year period. In 1980, the Bank of England base rate was around 17%.
17%.
Yeah. By 2020, it had dropped to near zero.
Wow. When borrowing is practically free, it radically changes human behavior.
It does. But this debt explosion drastically widens the inequality gap because the wealthiest and the poorest are participating in this system for entirely different reasons.
How so?
Well, wealthy individuals and corporations have collateral, like prime real estate or massive stock portfolios. Because they have collateral, the banks offer them the absolute cheapest interest rates.
Right.
So when rates drop near zero, the wealthy borrow massive amounts of cheap money to buy even more appreciating assets. This tidal wave of borrowed money drives the prices of houses and stocks even higher, multiplying their wealth.
Meanwhile, the poorest 10% of society are trapped in a totally different financial reality. Statistically, their total debts equal 3 times their actual wealth.
Exactly.
And because they don't have collateral to offer, they don't get the cheap rates. They're forced to take on high-interest, unsecured debt, like 20% credit cards or predatory payday loans.
And they aren't using that debt to buy appreciating assets. They're using it just to survive day to day and buy groceries.
So the middle class is caught right in the crossfire.
Right. The data clearly shows that the modern middle-class lifestyle is increasingly propped up by debt. heavily reliant on massive mortgages just to afford a basic place to live, while real inflation-adjusted wages have stagnated for decades.
And then there is the granddaddy of all debtors, the government itself. Let's look at the UK's national debt, which currently sits at a staggering £2.4 trillion.
It's a massive number.
And the danger isn't just the sheer size of the number, it's how highly exposed they are to rising interest rates.
Governments have run deficits almost constantly since the 1970s. For a long time, because interest rates were consistently falling, they could afford to borrow more and more without the monthly interest payments crushing the national budget.
Right.
But here is the trap they built for themselves. About 25% of the UK's debt is index-linked to inflation.
Meaning what, exactly?
Governments originally issued these bonds to prove to investors they were serious about keeping inflation low. The deal is, as inflation goes up, the principal amount the government owes goes up automatically to compensate the bondholder.
Oh, wow. So when inflation spiked recently, the amount the government owed just exploded.
It did. The government is now spending as much just servicing the interest payments on its debt as it spends on the police, courts, and prisons combined.
That is terrifying. What happens when the era of cheap money ends and interest rates stay high?
That exposes the fatal flaw in the system. If you've built an entire global economy on the fundamental assumption that debt will always be cheap and plentiful, a sustained period of high interest rates acts like gravity pulling down that house on the edge of the cliff.
Right, mortgages become unaffordable.
Zombie companies that only survive by constantly refinancing cheap debt go bankrupt. And governments have to divert massive amounts of tax revenue away from public services just to pay the interest on their ballooning national debt.
It's a very sobering reality, but understanding this vulnerability isn't just an academic exercise, it is essential for your own financial survival. If you know that fiat currency is mathematically designed to leak value over time to benefit massive debtors, you realize that leaving all your wealth in cash is a guaranteed slow-motion loss.
You start thinking critically about how to protect your purchasing power with scarce assets that cannot simply be typed into existence by a commercial bank.
It gives you a completely different lens through which to view financial news, inflation reports, and your own investment decisions.
You finally understand the mechanics of the ground beneath you.
Let's summarize what we've unpacked in our deep dive today. Money is a social construct that requires absolute scarcity to hold its value. Since 1971, our money has been completely detached from scarce physical assets like gold.
Right.
Today's fiat money is created out of thin air by commercial banks every single time someone signs a loan document. Central banks manage this by tweaking interest rates to encourage endless borrowing. And this engineered inflation quietly steals your buying power over time, stealthily transferring wealth from savers directly to debtors, especially the government.
It's a system that essentially punishes you for holding cash and forces you to become an investor just to tread water.
Yeah. I want to leave you with a final mind-bending paradox built right out of the mechanics we covered today. If every single pound, dollar, or euro in the modern economy is literally typed into existence through a commercial loan,
Which it is.
and if repaying a loan literally destroys that money, then a completely debt-free society would have absolutely zero money in circulation.
Zero.
Think about that. What would a future economy actually look like if it were forced to operate without a foundation of endless debt? Would it even be possible to function? We'll leave you to ponder that as you look out over the edge of the cliff.